All right, everyone, welcome to the Sherman Show. I am Jeff Sherman. We have a new co-host today, and his name is Mark Kimbrough. Mark, welcome to the Sherman Show.
Thank you for the invite.
Yep, you've been on the Sherman Show, but now you are actually a co-host. So congratulations on the promotion until Sam comes back from his travels. So he's not getting off the hook this easy, okay?
Hey, thank you very much.
All right. Well, with that, that is our new co-host, or at least interim co-host, kind of like the Speaker of the House, right, Kimbrough? You're just the interim co-host right now. We didn't oust Sam. He'll be back in the next week or so. But that being said, we have a special guest with us today. I don't think we've ever had a guest that wasn't special, but today is an internal guest. His name is Scott Thomson. Scott, welcome to the Sherman Show.
Thanks, Jeff. It's great to be here.
Well, Scott, instead of giving you titles and telling folks what you do, why don't you tell the folks what you do here at DoubleLine for us?
Sure. So at DoubleLine, I'm an ETF specialist, and I joined last year in January to help with the launch of DoubleLine's in-house ETFs. And since I've been participating in the broader effort, and day to day, I focus on running ETF capital markets.
Yep. And Scott, what you didn't let me do is tell the date today. So I'm always supposed to do that for compliance purposes. And for those that have stuck with us through this first 2 minutes of Scott's introduction here, today is October 11th of 2023, and we are recording live from downtown Los Angeles. So everything is as of this date, and Scott can only be responsible for things that occurred on October 11th, 2023. So Scott, you joined us last year over here at DoubleLine. Walk us through a little bit about your career, how you got in the ETF business, and how you first got interested in ETF capital markets.
Sure. So prior to DoubleLine, I was at a large fixed income manager down the street in Southern California, known as PIMCO. And prior to that, I had a few roles, but that was really the start of my career in institutional asset management, and traversed a handful of roles within PIMCO, focused on really serving as a fixed income strategist. And in the last several years there was more dedicated to ETFs. So in a way, I fell into ETF capital markets specifically, but it was trial by fire in that March 2020 was certainly a testing ground for fixed income ETFs as a vehicle. And I was on the front lines there. And since then, it was something where I enjoyed every minute and wanted more and more of it. And so when the opportunity to join DoubleLine and work with you, I was very excited. And so the journey continues.
Yeah. And so for those that didn't glean that from Scott's response there, Scott works on our macro asset allocation team with Kimbrough and myself. And he sits with us day to day. So when we're looking for a guest, he was an easy one just to go, hey, Scott, you want to join the Sherman Show? And who could refuse with that kind of offer? So, and he also actually sits right next to Kimbrough as well, right? So this is like a family reunion. We had to walk all the way downstairs to do this. But Scott, for those that don't know, explain what an ETF or exchange traded fund is. I've heard you explain it before, like it's like a mutual fund, but not open, closed. Explain to folks how the mechanism works.
So I think of it, the simplest way to think of it is a mutual fund that trades on an exchange. So you have intraday liquidity. It's a wrapped fund or vehicle that allows an investor to gain diversification to an asset class or a strategy all in one go. But the benefits that we've seen and really have helped drive the growth in ETFs are that it's generally transparent, intraday traded, there are tax efficient or tax benefits to the structure. And then, the other kind of comparison you tend to see is relative to something like a closed-end fund, where the ETF, I call it like an exchange traded mutual fund, is because it can grow or shrink in assets, but the price intraday will generally stay very close to that intraday NAV or estimated NAV. And that's a function of the creation and redemption mechanism. Whereas a closed-end fund based on supply demand can trade at a meaningful premium or discount to the NAV. and that gets arbitraged away and stays close to the NAV in ETFs.
Yeah. So maybe you can walk us through the evolution of the ETF. I've heard that, them being described as the next greatest thing, the biggest trend in asset management, the biggest trend in financial markets. Kind of walk us through the evolution and kind of what you identify as being some of the trends underway today.
So ETFs really began with the first ETF, SPY, in 1993. Fixed income began in 2002. And when the first initial product started to roll out, it was generally all passive. And as the market has evolved, active has become the hot new, it's not necessarily new today, but it's one of the biggest parts of the growing market. Active fixed income in particular began in about 2009. And that really started with short duration or short-term, ultra short bond types of strategies. And since about 2015 or so, DoubleLine has participated as a sub-advisor. That is something where we've seen a lot more in terms of product breadth, corporate bonds, mortgage strategies. We've seen all different types of slices as well as strategies come to the market. And we've also seen a lot more in terms of active equity in recent years as well. Just as managers have gotten comfortable with the wrapper, a lot of them have gotten more comfortable with transparency or understanding how their strategy can be employed in the ETF wrapper. And then there's also been a concurrent shift in the wealth market, in that a lot of investment advisors have gone independent, where they have more access to products, their own choices. And so the ETF vehicle, it's the simplicity of a single share class, the transparency, the access has also been met with that independent client or advisor market. And then as that all has grown together, you've seen participation from institutional investors looking at fixed income ETFs as an example for the liquidity and price discovery in the market. So it's really been growth coming across all different aspects of asset management, realizing the benefits of the ETF vehicle, and new types of strategies are coming out every day in terms of things like structured products. There's a lot of innovation in the market that is now occurring in the ETF wrapper, in part because it's one of the best ways for clients to access it.
I'm going to follow that up right there. You're talking about innovation in the ETF market. What can you tell us about some of the products here that you've helped launch?
So when I joined DoubleLine last year, the first two products that had already been filed and was really a team effort from DoubleLine was a U.S. Equity strategy that utilizes Professor Shiller's CAPE ratio, or relative CAPE ratio, for the methodology behind it, as well as a core plus fixed income strategy. And then we followed that up on the 1-year anniversary this year on March 31st with two other fixed income ETFs, active fixed income, that one focuses on residential mortgage-backed securities, and the other focuses on commercial real estate debt or low duration CRE or CMBS.
So Scott, you were very self-serving here in the innovation only occurred at DoubleLine. Let's broaden out the question a little bit. I appreciate what you're doing, but can you broaden this out a little bit? Talk about some of the innovation you've actually seen in the marketplace as well, not just the beautiful products that DoubleLine launched.
That's fair. So thinking about, first it was passive, expanded to active. Then we've seen semi-transparent in the U.S. equity format, which is a more recent innovation, as well as other derivative-based strategies. And really just as part of it is thinking about the liquidity landscape. And so market makers who are in the secondary markets for ETFs, helping provide an on-screen liquidity, bid and an ask, as they get comfortable with an underlying asset class, as that broadens out, as fixed income trading, for example, becomes more more electronified, that all benefits the liquidity and enables further product development. The big hot topic, I would say, over the last year or so has been these outcome or income option-based structured product in ETF wrappers, the buffered. Those have been, certainly of a hot topic. Commodity ETFs have been another in the last year or two in terms of number of products launched. And I think it's going to continue. The broad US equity market is starting to approach a little bit more of a mature state in terms of size and style. There's a lot of room to grow. And I think just from as this grows and grows, you're going to start to see how the mutual fund universe exists being mirrored in a way in ETFs, where you're going to see more fund to funds. Hopefully, one day, ETF share classes of mutual funds. There's a lot of potential further growth and innovation, but those have been the hot topics more recently.
Yeah, no, that is very interesting too. You talked about, improving liquidity. I always like to use the phrase "trader's going to trade," right? You give them something to trade, and they kind of understand a little bit, and they'll figure out how to make markets. And I've been reading the latest Michael Lewis book too. Just thinking about what the folks do at some of the people we trade with, right? And just seeing some of the interest there. But let's step back and let's talk more about Scott and less about the industry. And so you have this nice role of heading up our capital markets efforts here in ETFs. What does that mean? How do you explain this to your parents, what you do for a living?
That is, to my parents, might be a longer conversation, or it might take up a few hours here. But yeah, I'd like to think of capital markets as a distinct role or area of focus as having four core components. There is primary market activity. So that's creation and redemption of ETF shares, taking in-kind baskets of securities, negotiating that with APs and market makers. Secondary market activity. So that's on-screen trading, ensuring the liquidity provision and everything's functioning properly. Oversight with our lead market makers and other market making partners to make sure all of that experience for clients is, the machine is working. The third, I would say, is client execution services. So really helping clients in terms of education, if they are looking to do, purchase or sell in the ETF, or want to have a better understanding of how to do so, best practices, guidance. That's another area of, day-to-day can help with clients large and small. And lastly is kind of AP and market maker relationship management. So things just in terms of ensuring we have all the right partners to support our ETFs and the growth, helping raise seed capital from our partners who, participate and help us, grow a product, depending on the asset class and the specialty there. But those are really the four core areas. And then when I think of capital markets, it's a key part of the ETF as a business. And so I tend to try to wear a lot of hats and help in other ways that I can.
I was just seeing if Kimbrough wanted to co-host the show or not, but he looks like he's frozen on the screen there. So kind of like my webcast yesterday. So, okay. So we've talked about the beauty of the wrapper. We talk about what you do as a capital markets person. What is kind of the big kind of debate that's going on today in the ETF market with like active versus passive, right? I think initially everything was very passive. The ETX is your beta. It's a cheap way of accessing beta or getting, exposure to broad-based markets or certain niche parts of the market. Became very commoditized, low fee. Then the active has come on. Is there still this big debate of active passive going on within there? Is there room for both? How do you think about this?
So I think it's an interesting topic in the sense of seeing how it's evolved. Traditional asset managers for a while would just bash ETFs. It's, that's cheap passive. That's all it is. That's at one point it's going to turn or have some sort of negative view on it. As time has gone on, the trend hasn't stopped. And I think the conversation has turned more to, and I like to say it is, ETFs are the democratization of asset management, in that, whether you have $100 or $100 million, you can buy the same product for the same price, give or take. And so really, it's been able to for new investors to access a product. And as investor or managers have seen that, and in particular in equity ETFs, the tax efficiency is very important. And I think in fixed income, particularly since the COVID market shock and the illiquidity in fixed income, ETFs served as a price discovery tool. And really, the Fed buying those securities was not to bail out ETFs, but to actually help support the ETFs, because ETFs are so integral to the fixed income market for certain parts of the market today. So I think that the spirit of the conversation has changed more favorably to ETFs. But I also think it's we're getting mature in the market in some spots for passive. Just there are only so many indices. There are themes, and that can change over time. But active is probably one of the bigger areas of growth, just given the considerable asset base that's still in mutual funds that is likely to migrate to ETFs over time. And you're seeing it from separately managed accounts that are kind of converting to ETFs, mutual funds that are converting to ETFs. I would also say it's not a panacea for outflows or saving a mutual fund product that hasn't been successful, but for a product that's a better fit for investors in ETF form. For example, equity, tax efficiency or liquidity, you're going to see more growth there.
Hey, Scott, there was something you had mentioned earlier. It was cheap passive exposure. When I think of ETFs, or when I first heard about ETFs, I think of equity exposure. It's cheap exposure to get access to the market. But over the last decade, there's been some growth, considerable growth, in fixed income ETFs. What would you attribute that growth to?
A combination of factors. One is just the mention, as I mentioned, the different types of advisors that are seeking tools. A key point there, and it's a good question, as we've seen the growth in model portfolios. So these are we call them strategists that are providing asset allocation solutions. And so they're looking at ETFs as an efficient way to implement it. Especially in the last couple of years, when a number of brokerages moved to zero commission trading for ETFs, that really helped put a tailwind behind the use of ETFs, given that a lot of mutual funds still have ticket charges. And I've even seen in cases of large RIAs or other strategist types of clients where there's a limit just in terms of the number of mutual fund tickets they can do in a day. So it's frustrating just in terms of implementing a rebalance for a large book. So we've seen that come through. Low rates post GFC drove a lot of interest in products that were stepping out of cash, putting money to work. And then we saw the evolution in terms of active products, active core plus fixed income. And now that rates are higher, we've seen kind of that resurgence in interest in fixed income solutions. And it's also coming from an institutional client base where they can access, we saw $10 billion worth of high yield ETFs trade last week in a single day. There is ample liquidity, and that's because it's a well understood wrapper, and there's a very sophisticated set of liquidity providers behind it that now provide institutional level liquidity in a product that's available to your mom and pop investor as well as your large pension fund.
So you bring up the concept of liquidity, and this was taught to me by our friends over at State Street. And so for those that don't know, we sub-advise 3 funds with State Street. They don't compete directly with our products, just different offerings out there for different clientele. But the point of this is that talking about the liquidity of the vehicle that you're talking about, institutional liquidity, to the potential or let's say lower liquidity in the underlying assets. So I think of something like bank loans, for instance, which have a long settlement time and things like that. How does the ETF wrapper enhance this liquidity? I mean, again, this was, this is one of the big advantages that's always touted. How does it work? And then how do you explain it in layman's terms?
So I think of it as, one, there's just the nature of ETFs in that you have the secondary market and the primary market. And as volatility increases, you tend to see an increase in trading volumes. But the secondary market and the ETF that's on exchange trading, what we've seen is that it serves as a cushion or insulation for the fund. So 80% or so of trading occurs in the secondary market relative to that 20% that actually results in inflows or outflows. And so that means that when there's heightened volatility, it doesn't mean that a fund is just getting hit with redemptions or hit with creations and they have to put the money to work at an inopportune time. And secondly, as these products have evolved, the credit markets and trading have evolved as well. So a term that in kind of the cash bond trading world is portfolio trading. And that is economically equivalent to an in-kind basket and an ETF. And so we've seen the growth in this, both types of trading in a way. And so market makers that are trading an ETF and can do an in-kind basket, to create a redeem, are at the same time able to trade those underlying bonds in a portfolio trade and provide risk pricing. And it's also helpful for asset managers, whether it's a mutual fund or an ETF or an institution. So this combination of risk transfer across the vehicles has really enabled that growth. So you can buy $100 million worth of a bank loan ETF in a day without severely disrupting the market. So it's the everything coming together and the transparency that enables a lot of that efficient growth.
Step in here and want to mention you've talked about various aspects going on here, but I want to think of things that could help some of our viewers out there in terms of their trading in ETFs. What are some of the key points that you think investors should be aware of in using ETFs?
So from a trading perspective, I always want to say, one, just very, first off, always use limit orders. Don't use market orders. That just helps prevent you paying more than you want. So that it's cutting off the left tail and avoiding bad outcomes. But if you're looking to do anything in terms of, over a couple hundred shares, and if you're an advisor and you have a block desk or a trading specialist desk or trade support desk at your broker, give them a call. They are there to help you. And in many cases, that is the best way to get execution done. They'll do a block trade, and generally it's submitted through something called RFQ, which is request for quote. And so they'll go out to the top 3 to 5 or 7 market makers, banks, and other liquidity providers to say, give me your best price for, say, 100,000 shares of XYZ ETF. And so all those market makers will compete to give you the best price. And so it really is a win-win in terms of a good outcome for the client that's looking to trade, as well as you're getting interest and support from liquidity providers. And even if you don't have an immediate need to trade, I'd always say just, those specialists are there to help you. Give them a call. First, if you're just trying to figure out what's the best way to do a trade or a package of trades, that they're there to provide guidance. And similarly, if you're talking to DoubleLine, I'm always a resource as well.
Okay, Scott. So I want to rewind this a little bit because our compliance is not going to like that you promoted XYZ ETF. That actually is an ETF that's listed on the Ontario Exchange. So I knew that. So that was not a promotion of that. I think you were trying to make it generic, and I just happened to somehow know that. So anyway, jokes aside, let's talk about liquidity again, because I think the best practice is important, but I recall sitting in the middle of the pandemic, the first kind of week or so, watching the discounts on fixed income ETFs just widen massively. And we know the market was hung, it was frozen, there was no tradability. We saw these big discounts in the marketplace. And then when the Fed brought in the rescue package, right, when we started the beginning of the free money, the Fed will buy everything in the marketplace, all of a sudden you got huge premiums relative to NAV. You started off this conversation telling us about how well the arbitrage mechanism works. So explain to me what happened in March of 2020, and did it work right? And we'll probably have a few more follow-ons from there. So start with what happened there and your observations as you were doing your trial by fire back then.
Sure. So it was, there was a timeline in terms of the COVID pandemic and how risk markets started to adjust. Interestingly, in late February, we saw a sell-off in high yield, but that was well contained. It wasn't until early March when illiquidity in the treasury market rippled throughout high quality fixed income, namely corporate bonds, as well as other parts like municipal bonds. And so that, in a way, balance sheet was clogged up, and risk limits had gone through their limits. And so there wasn't a lot of liquidity, or liquidity providers weren't there to step in. And so what we saw was just an absolute, freeze in the underlying bond market. Pricing, I remember on front end floaters or short-term paper was 15 points wide if you got any sort of response. And so that was something where the ETFs were still trading. They started to trade, fairly quickly at a 3 to 6% discount. And what I see that as is one, they're still trading. It allows people to manage risk when there's a price. And in all market, these corporate bond markets have gotten more transparent, but back then they were less transparent. And just the ability to take on risk in that uncertainty was more strained. Whereas an ETF is trading, it's transparent in terms of what you're getting as a basket. And I like to think of the discounts. People, they've been described in multiple ways. They've been described as the fund NAVs were stale. And so these are the real-time prices or more accurate prices. And that's one way to describe it. I think it's correct. I think for me, I like to see it as it reflects transaction costs. So what you'll tend to see, ETFs will trade at a premium or a discount to a NAV. If an ETF is getting inflows, it'll tend to trade at a slight premium to NAV, a handful of basis points. But seeing redemptions, it's going to trade at a slight discount to NAV. And that's just a function of where a market maker can step in, buy the shares, and then redeem those shares, receive the underlying securities in kind, and then clear out of that risk. So for them to break even on that discount is essentially reflecting the transaction costs to trade out of the underlying, plus or minus some uncertainty premium. So that was the uncertainty, the illiquidity was what drove that discount on the way down. And then as the Fed stepped in, and it just completely flipped. Right, there wasn't a huge amount of liquidity, but at least it stopped and shifted the sentiment in a way to where now the price was trading. If you wanted to buy bonds, there weren't a lot of bonds to be sold to you, but if you were looking for them, that was the new price at where you wanted to buy them. So ETFs quickly reversed, and that quick reversal was also a function of the Fed stepping in to the secondary credit facility to buy a handful of fixed income ETFs. And that stabilized the market. And because you're stabilizing the underlying through the ETFs, it supported the broader market as well.
Okay. And so on that too, you talked about the liquidity, the perception of it. I mean, really, wasn't this just the price of the bonds at the end of the day? Because there wasn't really things happening. I mean, that's kind of what you're saying, right? When you talk about, the uncertainty of what's going to happen, is that, there was no transactions really going on. The only place to transact and do something to either insulate or offset some risk was in this market. And a market maker themselves are going to step in to kind of adjust for that uncertainty. Is that a fair way to think about it?
That's right. And I think the other point I would add to it is just that it's the individual bonds, there's 9,000 plus IG corporate bonds in an index. They're not those, a number of those bonds, hardly trade at all. So it's really more of a price of a basket. And that's, more efficiently priced via, kind of interest rate and spread duration or spread risk factors, which you look at a basket, and market makers are, very sophisticated and are able to do that. So it reflects that risk pricing on a basket level, which I think is important to keep in mind as well.
Okay. So as we think about this too, I mean, it seems like, that was the first kind of litmus test really for the fixed income ETF market, right? Yeah, there's just some beta out there in general, but you had active funds that were able to meet the liquidity needs, right? We had the passive funds as well, the kind of more beta stuff. But as you think forward, where do you think some the new kind of innovations are going to be in this space? I mean, you talked about fixed income, lots of sponsors are out there launching products, ourselves included, out there in the space. I'm looking out the window here. I see some of our competitors outside the window. They're doing the same. And so I'm curious, as you think about it, do you see the innovation being kind of mapping some of these products that exist currently in the mutual fund wrapper over, or are there going to, or do you see there being bigger uses of the ETF wrapper, things that maybe aren't on our radar today?
I would say both. That you're certainly going to see a lot of mapping over from mutual fund to ETF. I think it's important for asset managers to keep in mind that just having it in an ETF wrapper doesn't mean it's going to be bought. I think there's a lot of products, 3,000 plus ETFs out there today in the US alone. And I think that means that, distribution is a key part of that growth. But in terms of strategies, mutual fund, your traditional managers are certainly going to want to offer those in ETFs just to reach different parts of the clientele that they're not reaching today, as there are ETF only advisors or ETF power users that, majority of their in the book is focused on buying ETFs. And, I think there's going to be a lot of growth in other types of, clientele. Insurance, institutional usage, I think is going to continue to grow. Insurers are one of the bigger growing areas of fixed income ETF usage. There's going to be, I think, more of the fund to fund, and part of it is just, different types of regulations that enable that, right? 6011 was a regulation or change that enabled really the broader set of ETF issuers to become an ETF issuer. There was a very more complex regulatory framework to be able to launch ETFs prior to that. And so, and it allowed things like custom baskets and fixed income ETFs, which is really important, and for tax efficiency in equity ETFs. So that leveled the playing field, which is a good thing. And so we've seen a proliferation of product since. So now it's starting to get, the core areas of US equity and other, core pillars of asset management. Now we're seeing the more niche areas or pockets, seeing either innovation in terms of how to implement a strategy, where it's a understood strategy, and then it includes an overlay of options or swaps. I think you're going to see some layering of that in a way, in addition to structurally, whether it's a fund of closed-end funds, a fund of mutual funds, or an ETF share class. I think there's more that can be done in that is not really trying to make anything more complex, but to broaden the access to and investors to strategies and products they know, but might prefer an ETF. And so what's the best way to do that? And it sometimes can be through these new innovations.
Yeah, well, it sounds like you potentially have a future here at DoubleLine as there's more innovations coming and more things to do. And so, again, Scott, thanks for taking the time, jumping off the desk. We had to do this right after market hours so that our capital markets desk wasn't closed. So thanks for doing that. Do you want any parting shots out there? You want to say anything too that we may have missed that about the ETF or Scott Thomson that our 5 listeners really want to hear today?
Well, thank you, first off. And I think, reach out if you have questions. I think, we're at DoubleLine always happy to engage. I think, education is something that is going to continue to benefit investors. And there's going to be a lot of new products just from the industry. And so I think it's important to do your research. And it's exciting. There's going to be a lot of innovation. I think it's going to be good for investors. It just, to make sure that you're educating yourself and seeking help from folks like DoubleLine.
I think, as the Latin said, is caveat emptor, right? So thanks again, Scott. That was Scott Thomson, ETF specialist, runs our capital markets team here for our ETF business at DoubleLine, part of the macro asset allocation team, and still happy to be working at DoubleLine after month 21 at this stage. So thanks for joining us, Scott.
Thanks,
however, Jeff, in memory of our old co-host, Sam Lau, he used to have a favorite part of the show. And so in memory of him today, we'd like to introduce you to Sam's favorite part of the show. So new co-host, Mark Kimbrough, can you introduce Scott to that favorite part of the show?
All right, Scott. This is now my favorite part of the show. This is called Sherman Says. Well, I will offer a series of alternating prompts, hoping to elicit a one-word to multi-word response. We'll see where we go with it. But I'm going to start with Sherman, and let's kick it off. Geopolitical risk.
Local high.
Mr. Thomson, let's go rising rates.
Not much more to go. Hopefully.
Prior to geopolitical risk, they were. Yeah. I don't mean to make light of the geopolitical situation. It's very unfortunate. So,
next up, we have risk parity for you, Mr. Sherman.
Wow, they were blamed for some of the rest of the rate sell-off, right? As they were rebalancing some of that. I think risk parity is an interesting strategy. It's a way of thinking about asset classes, portfolio construction without having to forecast returns, which is very interesting. From a quant standpoint, it simplifies the optimization equation. The math is relatively simple. When you start to get into, you're just essentially trying to equate all the covariances in the portfolio. And what it does is it actually gives you much more stable profiles. The bad thing is that you historically had to lever bonds. And so you want to talk about the worst environment for a risk parity, even with the strong equity markets, you're having to lever up that really negative return. And so it's had a very challenged time. I'd be curious to see how investors react to this through the next cycle too, because it can do quite well, especially when equity goes out of favor. So I'll be curious to see if there, for some of the exodus that's been there, if it comes back as well. I as a quant, as I said, I like the concept as we remove one of the most difficult pieces. Now, we all have to say, can you get your covariance model right? Which no one has that perfectly, but there's ways of improving on that. So again, that was not a one-word response, Kimbrough, but I haven't talked about risk parity, really thought about it in a while, but except for all those times they get blamed for sell-offs in markets.
Like the taper tantrum. Right?
Yeah, exactly. I feel like they were part of what's happened in the last 8 weeks too. So there's just something about it. So
there we go. Well, you know what? Let's talk about something else that has kind of been on the back of people's radars. It's cryptocurrency.
For me?
Yeah, for you.
I'm not touching that.
Yeah. Not a good use of your money.
Oh, that's hot. All right.
So that Warhol behind you is? And the answer should be yes.
Yes.
Okay. Good answer. Good answer.
Yeah.
Going back to Mr. Sherman, let's go with bond vigilantes.
Well, they made a resurgence, right? Back 2 months ago, the bond vigilantes and the narrative, they got the narrative shifting massively. I think CTAs were a lot of the shorting too, the flip. There's a lot of CTA to buy, buying signals right now that looks like that they should be short covering now at this point. But it was interesting because a lot of folks we talked to we're saying, well, this is the deficit, right? The deficits matter. We're showing Congress higher borrowing costs. That was the old school bond vigilante, right? That this is not tenable. So even though I'm saying it felt like they were there, they really haven't done it. If you want to show Congress, let's make yields 22% again, right? And again, none of us want that in the short term. The pain you got to go to get there. But I think that the bond vigilanteism isn't there. Maybe it's because of Scott's ETFs innovation that it's just not much there. But remember, we saw creations in ETFs. They create to borrow, right? So that's another thing that can happen, is that you can create new shares to go and lend them out in the marketplace as well. So there's new mechanisms for being a bond vigilante. So I thought it was appropriate to give that shout out to Scott.
Nice.
I'm going to say thank you to Scott for keeping a lid on yields. It sounds like you're doing your good part.
Do what I can. Yeah.
Scott, back to you with U.S. consumer.
Surprisingly resilient, but it remains to be seen as things like the student loan and other things kind of hit in Q4 this year. But it's a key driver of economic growth, and just for the sake of the U.S. economy, I hope it's resilient still.
It's funny, Scott, you mentioned that, and I've been concerned about oil prices and how they lead over to fuel. And I bought petrol, gasoline. I bought it around 11 days ago, right before I flew to New York. So I drove to the airport, I got gas. And I drove and got gas yesterday morning again. So that tells you my timing, about 11 days apart. Gas, I paid 50 cents less a gallon. So, which is kind of strange for an uprising. I think I got fleeced a week ago. I'd been gone for a couple of weeks. I think I got absolutely fleeced. So that's the beauty of California. But maybe I don't feel a windfall now as I start to think about it. But I was like, there are things that can help offset that. And the old joke is like, if you want to ask a consumer what the inflation level is, just look at the fueling station, right? That's how people index their inflation. So anyway, random tangent. Lau doesn't let me do that, Kimbrough. So that's why I'm doing it today.
Well, I love random tangents.
I would say too, is just going on the weekend to Costco or any of these other places. They're so busy. It doesn't feel like folks are slowing down.
Right. Well, the other thing that our listeners need to recognize is that Scott loves Costco. He talks about Costco all the time. Any product that any of us talk about, he's like, oh, I get mine at Costco, or here's the Costco version. So I think secretly he has outside business activities. He's clipping part of that membership fee, but I don't know. But I think if there's one Costco fan at DoubleLine, I think that Scott would be the stan of this. Yeah.
I like it. All right. You know what? I couldn't be on today without this prompt, Mr. Sherman. The prompt is gold.
Oh, man, I was waiting for the Niners, man. Cowboys.
No.
There's got to be one of those in there, man. Got my Cowboy shirt on today, the colors. Gold, it can't give its own way. I mean, we have this big old geopolitical risk. It barely gets back to 1850 and sells off again, right? I mean, we were going trolling below it. Where we had 1860, maybe, it just really can't catch a bid. And so I'm going to put this back to you and say that a lot of the gold bugs are back on your previous question to Scott, and they're in crypto. So again, I don't know. It just seems that gold has a time and a place, and with yields where they are, I just don't love that shiny pet rock today.
I mean, we're back to positive real yields, so it's kind of,
they're meaningfully positive, like not just backward looking, forward looking expectations. I mean, it's hard not to think you don't have real yields, meaningfully positive real yields across the curve. And if you don't believe me, go look at the tips market. There's two handles in the 5s, 10s, and 30s, and they're a little bit even higher in 2s because of some of that inflation component. So in general, I just feel that the shiny rock is just, that's what it is. It's just something to make a loud thud right now.
Well, thank you for the shiny rock comments. I appreciate it. Scott.
And by the way, as much as Scott loves Costco, Kimbrough loves gold. If he could wear gold every day, if he could drive a gold car, if he could have a gold bike, he wants gold teeth. I mean, he loves gold. So, and I'm not mad at him, but again, everybody has their thing. Some it's Costco, some it's gold.
You can buy gold at Costco now, by the way.
I have heard, and I've
See,
been
I
tempted.
knew that was coming. That was a layup for you. That was an alley-oop there.
Yeah, it was. All right, Scott, we're going with mutual fund conversions.
I think it's hit or miss, or I don't think there's as much of a significant demand as folks first thought. And I think that's largely because just by switching to an ETF doesn't solve the potential challenges that a mutual fund might have. If it's not really picking up traction and distribution, if the track record isn't strong, it's still going to be tough to sell in an ETF versus a mutual fund. But with that said, I do think we could see future growth in certain products, and particularly for equity mutual funds.
All right. You know what? So we're coming to our last round here, and Sherman, you mentioned it. I'm gonna give you the floor on this. The world-beating San Francisco 49ers. What do you got?
You just said it, man. They look good. Look, they obviously look real good. Sorry for all the Cowboys fans out there, but the Cowboys are not the real deal. So I don't want to make too much of it. But I did hear an interesting stat, which kind of blew my mind, that it was when I was at the airport last week coming back from New York. They were previewing the game, and it said the 49ers are the first team in NFL history to score 30 or more points in a game for the first 4 games of the year. And to me, it just seems like with all these like high-powered offenses and the Mahomes, you would think that has happened before, right?
Easily. Would have guessed.
But I can easily tell you this. The Niners are definitely the only team to do it the first 5 weeks in a row, because they put up 42 last week. So, look, they look good. Brock Purdy looks like the real deal. So when Mayberry hears this from the desk, and he's been doubting Purdy, say just throws dink passes, he stepped up in the pocket. He looked really good. I just don't think the Cowboys are as strong. Still scared of week 13 with the Fly Eagles Fly. Teddy Hospodar, we're coming to your house. I don't know how that's going to work out. It's not a friendly environment. Probably going to watch that from the confines of Los Angeles couch, because I'm a scared man when it comes to Philly Eagles fans in their home place. But again, Niners look good. It's a long season. I did see a Browns fan this week, and it told me to watch out. They're the real deal. So I don't know. I'll take my chances there with the dog pound. But anyway, sorry about your Jets still. We always commiserate for it. But hey, Bears are on the board now this week, right? We've got the defeated teams are waning. And so look, you're getting back in your draft pick form as you do. And for those who don't know, Kimbrough loves gold, I already told you, but he says his happiest day of the year and his peak optimism is draft day every year. It's the best day for a Jets fan, and it's all downhill from there. So enjoy our old coach. Saul is a stud. Your defense looks awesome, though.
Thank you. It's it's painful, but it's all true. So it is what it is. You got to roll with it. It's my team.
Yeah.
Scott, I told you that there might be something sports related here. What I got for you is EFT guy. You can give a little background.
EFT guys is my nickname on our fantasy football league. Currently 3-2, stuck with my auto draft and haven't made a change since. And that's probably going to be my strategy for the rest of the season. EFT guys is the joke because someone was referring to me as the ETF guy here at DoubleLine, but they spelt it as EFT. And then the running joke has been I'm the electronic funds transfer person. So that is, the nickname EFT guy.
Yeah, and I did call Scott this week because I said, look, I gotta move some money on these T-bills. I gotta pay taxes. Like I need my EFT guy, So anyway, thanks for that. And for those of you who don't know about our team's fantasy football that our little team plays, we just play it for fun, of course. And it is truly a random number generator. You don't get to pick any of your players. And so, we try not to drop. There's penalties for actually going to the waivers list, of embarrassment around the desk. So you want a different spin on fantasy football that anybody can play, go to the RNG Taco Bell League. That's what it's called. So anyway, thanks, Scott, for joining. Kimbrough, thanks for filling in. It was a pleasure. We'll have to have you on more often, Kimbrough. You did a great job as the co-host. No hey-heys, but we'll get you your own tagline. So again, thanks everyone for tuning in. You can catch all these episodes on youtube.com/DoubleLine Capital. We serve these up where all the podcasters serve through the various apps these days for those of you back in the commuting game. But more importantly, stay tuned as we will have a new guest shortly. Thanks again, Scott, for joining us today.
Thanks, Jeff. Thanks, Mark. It's a pleasure.